battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. I'm Nick Stenger. We are the Stenger Family Office. For the past 44 almost years now, it has been our mission to deliver both clarity and confidence to help secure your financial future. First show 2025. And if you are looking back on those 44 years, man, one of the best bull market runs in equities that we have ever had in history. Imagine if you had been sitting in gold bars, silver coins, canned food in your backyard, thinking I'll be safe and secure with my treasury yield at 3.5 or 4%, which is now the long-term yield on treasuries. And instead, the stock market has produced unbelievable returns for investors. That's why we try to come back each and every week and tell you to stay on your plan this week. Episode 172, stocks sometimes go down. A little bit contradictory that I think stocks over the long run will go up, but just be prepared. We have not had a major correction in a little bit. We came off of 2023, melt your face off record year, over 20% return in the S&P 500. We did it again in 2024, up 23.5% last year. Don't be surprised if we hand a little bit back in the short term, but I still think even if we finish up 7, 8, 9, 10% for 2025, that's a phenomenal return. Let not your heart be troubled if you see a 7 or 8% equity return. Do not panic. Don't jump off the ledge because equities aren't 20% positive this year. I still think we're going to have a very good year ahead of us. I would equate it to Patrick Mahomes won the Super Bowl in 2020. He skipped 2021 and 22. He came back in 23, won it again, 24, won it again. And now we'll see if he wins it again in 25. I know some of you may not like him. That's okay. But he is a great example of what the stock market could do. We could have 1 or 2 really good years in a row, but just because we get to the semis and we don't go on to the Super Bowl and win the Super Bowl doesn't mean that we have a terrible team or produced a bad return in this case of the stock market. So we could have 2023 be a phenomenal year, 24 be a phenomenal year, and maybe we make it to the semis this year in the market. We're up 7, 8%. Who cares? That's still pretty good. We didn't win the Super Bowl necessarily, but that is not a bad return. So stay on your long-term plan. I do think, like Dr. Ed Yardeni, who was just on CNBC last week talking about this, I think we are due for a correction, and I think we're going to have a little bit of volatility. You're going to see President Trump come in and be inaugurated here in a few weeks, and he'll start talking about what he would like to do. You see this consistently. You saw it the first time around in 2016, where he comes out and he says, this is what my policy is going to be. And markets panic. Markets react very negatively in the short term to maybe trade war, for example, or to some of the inflation prints we'll get or something like that. And that, to me, is just a phenomenal buying opportunity. Not if you are trying to get a 10% or 20% return in 3 months, but if you are trying to be on a long-term investment plan, anytime we see the market go down 4, 5, 6, 7% like that, maybe even have maybe a 10% correction this year, who knows? That is a time to buy. And I told you this when the S&P went down 3 or 4% the other week, and now it's coming back. We're in the pre-market today. We're recording this Monday morning, so who knows what the market's going to actually finish out today at. But I believe we're going to finish up positive, almost back at the record all-time high, which is almost 6,100 points on the S&P. So if you bought at 58.50, you got a nice little jump for maybe 4%. When it's all said and done, maybe you'll get 10%, and then we're going to correct. I was looking at somebody today talking about NVIDIA. When NVIDIA's earnings come out, by the way, the stock is back up now almost to 150 in the pre-market. We were buying it again for clients around 106, 107, 108, and it's now going to be almost 150 again. And I believe what you're going to see is the stock will rally into earnings. That's typically what happens. Maybe the earnings number doesn't come in exactly where people had hoped, and the stock corrects 10%. You're going to look at NVIDIA stock on that day down 10%, but you may be right back to where you started. You might be able to buy that stock at 140, 150 again. And so when it's all said and done, just stay on your plan. Why should you panic? Why should you try and get out and then try and time it and get back in? You know, we've got clients who do this, and despite our best efforts to tell them don't do this, certainly we don't do that at Stenger Family Office with the money that we manage for them. But one of the things I see as a big mistake is people try to time the market in their 401k. What a major mistake. Like, why in the world would you try and sit and time a long-term asset? In most cases, you're not going to touch the money until you're 59 and a half. Or you're going to touch some of it, but you're certainly, if you got $2 million in your 401k, you're not going to touch all 2 million. So why in the world would you go take $1.5 million of your 2 million and go sit in treasuries and try and time this out? There's no logical reason for that unless you have a cash need over the next 2 or 3 years of $1.5 million of $2 million. Okay, sure, then you could go sit in some treasuries. But most of us are going to spend maybe 4 to 5% of our account value on a retirement plan. So if you take 4 or 5% over 5 years, the max you'd want to have in treasuries is 25%. And so I just think be careful, and you're going to see people do this now, especially this year. They're going to say the S&P is at all-time highs. Now's the time to take my profit and get out while the getting's good. Well, they may be right in the short term and miss a 10% correction, but the problem is they got to be smart enough and quick enough to get back into the market and be right twice. That's very tough to do. So, like I've encouraged you to do on the show, Peter Lynch said it the best. More money has been lost preparing for a correction than in the actual correction itself. Don't try and prepare for these corrections other than preparing your financial plan, your goals-based financial plan ahead of time. And so what do you do to prepare for a correction? Most of it's behavioral, because once you have a good fiduciary financial advisor putting a financial plan to you, together for you, that's according to your individual circumstances and goals, now you can rest easy and not have a panic attack every time the market goes down. And that's what I would encourage you to do. Prepare mentally for this. Prepare your behavior to not panic. Put your phone away for a little bit. Close down your Charles Schwab account for a second and go for a hike. Go for a walk. Go to the beach, wherever you are. Just enjoy your time. You don't need to be checking your statement every 2 seconds. You're not going to add $1 to your portfolio by worrying, and I would take that directly from Matthew in the Gospels. You're not going to add a cubit inch. You're not going to add anything to your height by worrying, and you're not going to add $1 to your portfolio by having a panic attack. So stay on your plan. You will be okay. Your future is secure if you're on a long-term goals-based plan. I just want to make one comment on a comment that we received on the YouTube channel this week. So thank you, whoever did this. I don't know who you are, but thank you for watching and thank you for commenting. You said, wow, you are optimistic on the last episode. That was episode 171. Yes, I am. I'm optimistic for the long run of the U.S. economy. So yes, in the short term, stocks could go down. Yes, in the short term, stocks can have a correction. But why am I bullish long term? And I'll give you my basic answer, and that's the great wealth transfer. That's what a lot of consultants have called this major, major transformation. About $84 trillion in most estimates. Some are as high as $120 trillion, some as low as $60 trillion that will be passed from the current generation to the next generation, whether it's the war generation to the baby boomers, or the baby boomers, most importantly now, to the next generation, the millennials. And there's just going to be this massive changing of hands of money. Not to mention, baby boomers, when they retire, many of you, our clients, are not just sitting at home doing nothing. What are you doing? You're traveling, you're spending, you have a negative savings rate, you're going out in the economy, you're maybe buying a new car. And by the way, you're not financing the new car if you've been diligent with your finances, like most of our clients have been. You're paying cash, and then you're going out and maybe going on a big vacation. Maybe you're doing a riverboat cruise to Italy, and you are spending money like it's going out of style. And why are you doing that? Because in 2023, you made 20%. In 2024, you made 20%. I'm saying if you're 100% equities, most of us were not 100% equities, maybe 75 or 80 if you're retired. Okay, maybe you made 15% back to back both years. That's not too bad, by the way. And so you're saying to yourself, now it's time to go spend some money. I didn't spend any money in 2020. I barely spent any in 21. I just got back to traveling perhaps in 2022. And now it's time to go and get moving here. And so I've encouraged many of you, if you're in your 60s or your 70s, now's the time to do it. If you can afford it in your financial plan, now's the time to go enjoy what you've worked so hard to save and accumulate. And that's what you're doing. And so I am positive on the U.S. economy long term, number one, because baby boomers are spending money now, but number two, because they're also going to be passing a lot of that wealth down to the next generation. And a lot of that wealth will not get spent or saved, rather. It will get spent. And so if you are in the luxury goods business, you are probably going to be doing very well. If you're in the services economy, you're going to be doing very well. If you are in the experiences category, people are trading a lot of things and items with gifting to experiences, which is a really neat shift we're seeing in the economy, that's what you're going to be doing. You're going to be doing very well if you offer those products and services to your customers. And that's what we want to be on the forefront of is investing in companies that are going to benefit from this great wealth transfer. So that's one of the positives I see. Here's another one. And you are looking at the stock market today saying, Nick, is the stock market overvalued? We're trading right now forward earnings of about 20 times, current earnings about 24, a little bit higher than usual. That's correct. But what I want to just point out is a lot of that multiple expansion we've seen the past couple years. First of all, we really haven't seen runaway multiple expansion. If you go back 4 or 5 years ago, we were still trading the S&P around 18 to 20 forward multiple. So it's really not that out of whack. But if you take out the top 7 or 8 or 10 companies of the S&P 500 now, the rest of the index is only trading for maybe 15, 16 times forward earnings. That's really pretty reasonable. That's about the long-term average. And so just be careful to the people out there who are saying the market is trading higher than ever before, or this Case-Shiller index where they say, oh, stocks are radically overpriced and here's my metric to prove it. Well, just be careful because we have to really understand what are we buying in the S&P. The top stock in the S&P, I believe, I didn't look at it this morning, but it's probably going to be NVIDIA. Let's put NVIDIA on the sidelines for a second. Let's talk about number 2, which is Microsoft. Microsoft is trading for about 30 to 35 times earnings, and you're saying that's really high, right? That's a lot higher than the 24 that the rest of the market's trading at. Is Microsoft overpriced? Well, here's my answer to you. Give it some critical thought. Think through Microsoft as a company. You would not be able to do most of your job if you're working without Microsoft. In fact, if you didn't have Microsoft, if you didn't have Amazon Web Services, AWS, if you didn't have Google Cloud, if you didn't have a lot of these services, you literally couldn't do your job. There has never been a point in history where more companies rely on a company like Microsoft or a company like Amazon with AWS or a company like Google with Google Cloud or Palo Alto Networks or CrowdStrike with the cybersecurity than ever before. In fact, if you're an energy company, has nothing to do with technology from a AI standpoint, probably, at least not on the surface. Even energy companies, industrial companies, manufacturing companies today are reliant on technology like never before. Healthcare companies are relying on technology. Our companies are relying on technology. So is it fair to put a 35 multiple on Microsoft stock? Look, I don't know. Maybe in the long run, I'm wrong. Maybe 35 ends up being too high. But I can tell you it's just an irreplaceable asset as of now. It would be almost impossible to replicate what Microsoft has done. And so I equate that to real estate. I talked about this at our Investor Day last year in November. And I said, think about Palm Beach real estate. Palm Beach just had the highest price point house sell ever in history. Ken Griffin from Citadel moved out of Chicago, got fed up with Illinois politics with J.B. Pritzker here and the disastrous Illinois political climate. And he got out of here and he moved down to Florida. And he goes down to Palm Beach and he builds a billion with a B, $1 billion house, which is crazy. I mean, we can't even imagine what that house is going to look like. It's ridiculous. But the point is if you've ever been to Palm Beach, the real estate is just insanely valuable. Why? Limited supply and massive, massive, massive demand. And that's just Econ 101. So if you want to get a really good understanding for how stock prices work or for how companies operate, you just need a good understanding of economics. You need a basic understanding of supply and demand. If there's more people buying than selling, prices go up. That's just the reality. And so what would it take for Palm Beach real estate to not do well? Well, maybe it gets wiped off the face of the earth with the next hurricane. I don't know, probably a low probability event. I would think maybe you could have insurance costs perhaps go through the roof. Who knows? There's, maybe 5 or 6 things. Maybe liquidity dries up. Maybe the people that are buying the houses down there for whatever reason need to sell the house because they need to get their money out. But in most cases, you don't have a liquidity crunch unless you have a leverage problem. And most of these houses, like Ken Griffin's house, I don't know for a fact, but I would guess he's paying cash. He's not doing a mortgage on it. So why would he ever have a liquidity crisis? Why would he ever have a problem of needing to sell that home? And so this is where However, you have to understand 08 and 09 was such a weird event, such a unique event in history, because we literally had almost no lending standards. We also had mark-to-market accounting. You had people with no income verification buying 3, 4, or 5 homes. And today that's radically different. I'm not saying we couldn't have a black swan event that we don't see coming like in 08 and 09, but you have to remember at the bottom of 08 and 09, we didn't have a reversal in stock prices until the Fed removed this mark-to-market accounting rule. And that's what let the stock market go back up. And so I think today it's very likely that people are in pretty good shape. Consumers have strong balance sheets. And so I think about you, our clients, in a lot of cases. You're retired, you have cash in the bank, you've got money in the market, you've been up 30, 40% the past couple of years, and you have most likely no debt. You're not going to do anything that's going to require you to take on debt. And so I think what's going to continue to happen is asset prices will rise. And so this is why I've said, on the other side of the equation, be careful with long-term bonds, because asset prices going up is inflationary. It's part of life. And so you're going to have a few percentage points of higher prices. Why? Because I think supply is still going to be low for a lot of goods and services, and supply is going to be low and demand is going to continue to be strong, especially as you have this great wealth transfer. You're going to have more money into the markets. You're going to have more money chasing U.S. assets in general. Why? Because we're the last and best hope on earth. You may say, Nick, U.S. is horrible and awful. We have all these problems. Yeah, every country does. And our country happens to be the one where everybody wants to be. So you can say how horrible the U.S. is, but I'm sorry to tell you, people literally get in rafts across shark-infested waters from Cuba and come to Miami. So that's the reality. You never see a life raft going the other way back to Cuba. And so because of our policies, because we have the rule of law, personal property rights, because entrepreneurs from all over the world want to be here, and I think it's going to be tougher and tougher to invest capital in other places on earth. So it's very tough to invest capital in Europe. It's very tough to invest capital in China. You're going to see those dollars come to the U.S., especially with Trump 2.0. And you may not like Trump. I'm not telling you that you have to love the big orange man. I'm not telling you have to vote for him or anything. I'm not telling you anything politically. I'm just telling you I think a lot of policies that Trump is going to do are, one, going to be inflationary, but number two, are going to bring a lot of dollars back to the United States, a lot of investment dollars. So what are you buying when you come back to the United States and you go into the S&P 500? You're buying more Microsoft. You're buying more Apple. You're buying more Amazon, more Nvidia, more Netflix, more Google, more Procter & Gamble, more McDonald's, Walmart, and all these massive, well-run U.S. companies. I'm not saying every single one of them's perfect. I'm not saying they don't have any problems, but they didn't get into the S&P 500 by accident. They're very, very strong, good companies, and many of them have the best balance sheets they've ever had. And so as you see more and more investment dollars come back to the U.S., as you see more and more investment come back, as you see more and more people continue to contribute to their 401ks, and naturally every single week or every 2 weeks buy more S&P 500 in their 401ks, I believe you're going to have more demand for stocks than supply, especially the best companies. And I go back to my Econ 101. When you have more demand than you have supply, what happens to prices? They rise. And so I would be bullish on the long term of the U.S. economy. Not every company, not every single stock, not every single industry, not every single place on earth, but I think for a select group of U.S. companies that have good balance sheets, have good operating models, you're going to continue to see their stock prices go up. So what causes these recessions or these corrections in the short term? Well, a recession is textbook definition is defined as 2 declining quarters of real GDP. So what's real GDP? It's inflation adjusted. You could have a rise in GDP nominally before inflation, but once you back out the inflation rate, that's what we really care about. We want to see how much did you really grow your economy when adjusting for inflation. And we had that in 2022. Nobody wanted to talk about it. I'm not a conspiracy theorist, but we were in the middle of an election cycle, and nobody wanted to bring up the fact that we had a recession in 2022. Maybe a few years from now, the National Bureau of Economic Research will call it a recession like they should have. But the stock market told you what the government didn't. And they told you that we had a recession. Stock market was down 20% in 2022. You don't get a 20% correction without a recession. And that's what we had. We had a mini recession in 2022. I think we're in the early part of a recovery now. And so all these people looking out in the distance saying, oh, where's the next recession? Where's the next crisis? Well, I think we already had it. I think we had it in 2022. It was a mild recession, but it was a recession nonetheless. And so when you start looking at CapEx at companies, when you start looking at hiring now, you start looking at how companies are doing, they're not talking like the end is near. And I will tell you, companies are one of the best indicators of what's coming. They will tell you if they think there's problems. They'll say demand is weakening, demand is soft, people aren't spending as much, which you're seeing from certain companies. You're seeing from Walgreens. You're seeing it from Macy's. You're seeing it from Target. You're seeing some of these companies say, hey, our consumer's slowing down. But you're not seeing it across the best companies in the S&P. Amazon certainly is not slowing down. Walmart's not slowing down. Costco, the line is 20 minutes before it opened, there's 50 people outside in Naperville here waiting to get in. Costco's consumer is not weakening, and they're doing quite well. So my point to you is I think over time, we're going to look back and say we are in the early stages of a recovery that started in 2023 and is just getting going. Okay, so those are recessions. Market goes down maybe 20% in a recession. What about just a regular correction? Well, you saw we almost hit a 5% correction the other week. 10% is not unlikely. And actually, we get a 10% correction statistically once per year. We haven't had that in 2024. It's only been a couple trading days. So that's why I'm telling you, just be forewarned. You could see the S&P go from 6,000 to 5,400 or 5,500, and you should not have a panic attack about this. Just be aware of the fact we're talking about it today. You can go back and watch this episode and say, oh, okay, we were prepared for this. We were ready for it. That's your big buying opportunity again. So I would tell you today's a good buying opportunity. When you have the money's a good buying opportunity. Why? Because if you're in a long-term goals-based plan, you shouldn't be investing your short-term savings or your emergency fund in the market anyways. You should be buying money market and treasuries. If it's your long-term capital, and let's say you're looking at a 3 to 5 year window before you're going to need a lot of that equity money, well, why wouldn't you be in the market? I think we could all agree, despite a short-term correction, 5 years down the road, market's going to be up. I've got my crystal ball here sitting on the table, and I look into the crystal ball and I say, hey, 200 years of market history, S&P's up 10% a year for 200 years. Well, history has favored optimism. History has favored people on a goals-based long-term investment plan. So stay on your plan. Don't panic here. Don't lose heart if you see a correction in the short term. I think in the long run, you're going to see the S&P continue to go up despite any corrections or stocks going down in the short term. Remember, we're going to get to the promised land of 67, maybe 7,000 points on the S&P. It's just not going to be a straight line up. We're going to have some bumps and bruises along the way, and you're going to be happy. At the end of it, you stayed on your plan. Thank you so much for being here, episode 172. We'll see you next week for episode 173.